Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The global trade war escalates. 25% US tariffs on Canada and Mexico are now in place, with Chinese imports hit by 20% levies. Beijing immediately fires back, targeting US food imports. Canada also retaliates. Donald Trump pauses all military aid to Ukraine, turning up the heat on Volodymyr Zelenskiy after their testy Oval Office meeting. Plus, sliding further, Brent crude trades near a 3-month low after OPEC Plus announces a surprise increase in oil output. Good morning. It is Tuesday. Those tariffs are now in place. $1.5 trillion of goods affected by 25% tariffs on Canada, Mexico, and an additional 20% on China. Retaliation from China and Canada. This is now trade war territory. And does it expand globally, with tariffs threatened, of course, on Europe in the next few weeks from this Trump administration? Talking of Europe, you saw fresh record highs on European equities yesterday, driven by the defence space. It's a different picture today. Losses being flagged by the European Stocks 50 futures, currently pointing down by 0.8%. Here in the UK, FTSE 100 futures pointing lower by 0.5%. You're seeing commodity space under pressure as a result of this trade war escalation. S&P futures, though, pointed to gains of 0.3% after a heavy sell-off on Wall Street yesterday. Close to 2% declines on the S&P, more than 2% on the Nasdaq 100, and the Russell 2000 small caps being crushed by trade expectations, tariff expectations, and weaker economic data now out of the US. Nasdaq 100 futures, though, pointed to gains of 0.4% after the heavy selling of yesterday, with a particular focus on those tech names. Let's flip the board and have a look cross-asset. Markets now pricing in 3 rate cuts from this Federal Reserve, almost 3 rate cuts, as you see moves into treasuries. The bond market rally has taken place now. Equities selling off since the Trump inauguration. That Trump trade pivot is now pronounced. 4.15 right now on the 10-year. The 2s and 5s are back below 4%. 104 on euro dollar, currently unchanged. Brent at $70 a barrel, with OPEC Plus coming through with that surprise announcement of more barrels on the market coming through from that cartel, currently down 0.9%, and Bitcoin at 84,000, the cryptocurrency falling 1.3%. So China and Canada announcing those retaliatory measures against the US after the Trump administration went ahead with those tariffs. 25% levies are now in force on all US imports from Canada and Mexico. If you put Canadian oil to one side, tariffs on Chinese imports have doubled from 10 to 20%. President Donald Trump yesterday speaking, saying he's going to be dashing hopes of any last-minute reprieve.
On the tariffs, is there any room left for Canada and Mexico to make a deal before midnight? And should we expect those Chinese tariffs, the extra 10%, to take effect tomorrow?
No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow. China also had an additional 10, so it's 10 plus 10.
The tariffs target the top 3 US import sources, hitting annual trade worth about $500 billion. The total value of goods, though, impacted by tariffs, about $1.5 trillion. Bloomberg's Brendan Murray joins me now for the details. Brendan, what do we know about the tariffs that have been imposed just in the last 30 minutes or so?
Yeah, it was 5 years ago. Well, the big surprise really was the Canada and Mexico tariffs. I think everybody anticipated that the extra 10% would hit China. But there was a lot of skepticism in financial markets in particular that he would actually go through with hitting the North American trading partners with these tariffs. It was only 5 years ago where Donald Trump renegotiated the NAFTA agreement, called it USMCA, said it was the greatest, most balanced, most powerful trading alliance in the world. This was going to help the U.S. stand up to Europe, the European Union, stand up to China's economic might. This 3-country alliance would help do that. Now he's shredding it, apparently, and putting at risk, the supply chains that extend from Canada to Mexico, particularly auto industries, but also consumer electronics, food production flows back and forth of these borders. So we'll see if this is some sort of gambit. He thinks he can bring the three to the negotiating table in a couple of days, but if this lasts for weeks or months, I mean, we're looking at auto companies shutting down, trying to figure out how they're gonna make a profit now that 25% tariffs are going on the cars and the parts that move across these borders.
Yeah, and Yale University putting out some research suggesting it could cost US households an additional $2,000 per year. Canada and Mexico retaliating then, Brendan?
Yeah, they don't have as much of our products to put tariffs on as we do of theirs, so that will certainly hurt, particularly in the border states. But we haven't seen what Mexico will do yet. That'll be interesting to see. They promised that they would be more deliberative, not have something in place to snap into effect the way the Canadians and the Chinese did. But certainly we're in the throes of a regional trade war, the likes of which we haven't seen in a long time. The average U.S. tariff rate, based on all of these that have gone into effect, is now the highest since the 1930s. And I think we know what happened when tariffs went on in the 1930s. They prolonged the Great Depression. So we'll see if this gamble pays off, but in the interim, the economists are predicting there's going to be a lot of economic pain associated with it.
OK, tariffs at the highest rate since the 1930s. Brendan, thank you very much indeed. Yes, Canada retaliating, China retaliating, Mexico still working out their next steps, it seems. Our global trade czar, Bloomberg's Brendan Murray, with the details. Market reaction then, waking up, of course, to the reality of Trump tariffs, with Asian equities tracking Wall Street lower on concerns about inflation, of course, and the supply chain disruption that will come about as a result of these tariffs. Let's bring in Bloomberg's Valerie Hetal for a finger on the pulse of these markets and their reaction, Val.
Look, finger on the pulse of the market. Doesn't seem like there is much reaction to the actual implementation of these tariffs, to that midnight deadline that we crossed just an hour ago. Looking at how S&P futures fared over the headlines, they barely budged, Tom. Maybe we already priced all of this in yesterday, that big slide in the S&P 500, its biggest drop of 2025, that drop of 1.8% yesterday, but unfazed in the face of this tariff implementation. Let's also check on the FX market, because dollar CAD also quite unfazed around the headline that crossed around an hour ago. We've actually strengthened in dollar CAD after the headline. And the same thing's been going on with dollar MEX. Yes, the currency weakened yesterday, but on the headline of the implementation of these tariffs, we've seen the Mexican peso actually strengthen versus the U.S. dollar. I think the market is going to be on tetherhooks to await Trump's comments as his joint address to Congress later today. If he's still pitching these tariffs as a good thing for the U.S. economy, that could rattle the confidence in the equity market.
Yeah, it's hard to see how he doesn't continue that line. He's really been consistent on that, hasn't he? So we look ahead to that speech then from President Trump to see if he doubles down on this or suggests there is any room for compromise. Valerie Hetal, thank you very much indeed with the market reaction here to the tariffs that are now in place, of course, on Canada, Mexico and China. Let's bring in, talking of China, Avril Hong standing by in Singapore for the Asian market reaction. Avril.
Yeah, Tom, really interesting the moves across Asia today, because we saw declines of almost 1% on the region's benchmark earlier, but it quickly pared the losses despite tariffs doubling for China and China responding with retaliatory action. It doesn't really look like what you'd expect. Chinese stocks actually pared earlier losses, the Hang Seng Tech managing gains. Some have pointed to this buy the rumor, sell the fact going on. Maybe also that China's retaliation was not as bad as some had expected. Also, traders may be looking ahead to the China MPC stimulus hopes there. The one market that seems to be reacting, as you think, to the start of a trade war is Japan, leading declines. Selling here also exacerbated by the yen's firmness today. Flipped the board, along with the climbs in the yen. The gains are also being seen in the renminbi. These are among the two currencies that Trump have singled out, kind of saying that he doesn't really like the weakness because that benefits the trade of China and Japan. But note as well that the renminbi's firmness today is also to do with the yuan fixed signals that they are prioritizing the PBOC, the stability in the Chinese currency. So maybe the idea being dashed that they will allow for more depreciation to deal with tariffs. Flip the board again. I just also want to highlight what we're seeing in the G10 APEC currencies. They are really moving different directions when you look at the renminbi versus the Aussie. As you know, these two currencies tend to move in the same direction. The other thing is the yen gains today. It is seen as a beneficiary of these tariffs, some of this because of Trump's comments, but also safe haven demand, and also the closing yield differentials given how U.S. yields have moved. Tom.
OK, safe haven trade when it comes to the Japanese yen. Avra Hong in Singapore with a market check and the lens on Asia. Thank you. China retaliating then by imposing tariffs on US soybeans and other farm products. For more, let's bring in our chief North Asia correspondent, Stephen Engel, who is outside the Great Hall of the People in Beijing. Steve, what is the latest then in terms of Beijing's reaction to these US tariffs?
Yeah, we've been out reporting all morning before dawn, essentially expecting some sort of countermeasures as MOFCOM, the Ministry of Commerce here in China, just as the business day got started about 9 o'clock, vowed retaliatory measures. And sure enough, within the last hour or so, we've gotten those measures. And as Avril just said, you know, the market is reading it a little bit more muted. Keep in mind, you know, the United States buys more than 3 times more products from China than China buys from the United States. So there's not going to be necessarily like-for-like tariffs, but they have added extra tariffs of up to 15% on a number of U.S. goods, notably a lot of key crops. So we're talking soybeans, sorghum, and corn as 3 major crops where there will be a 10% tariff added as of March 10th. Also beef, chicken, cotton, fruits facing 10% tariffs as well from the United States into China. So there's also these entity lists, this unreliable entities list they've used, adding American companies. We've seen another 10 U.S. firms added to that unreliable entity list. Mostly defense-related U.S. companies. And again, MOFCOM citing arms sales to Taiwan as a major reason. They've also added an additional 15 companies, again, mostly defense-related companies, to the export control list of China. Interestingly, though, Tom, one tool that China has often used are export controls of rare earths and critical minerals, like they did after that first batch, or first salvo of tariffs of 10% that we got in the beginning of February. They limited export of tungsten-based minerals. Also in December, we saw gallium, germanium, and other key minerals restricted further in the sale to the United States. This time, as far as we can see from the readouts, it doesn't appear that they're using that lever right now. But of course, that does not mean they won't in the future.
OK, Steve, you're outside the Great Hall of the People, of course. You're standing in Tiananmen Square. You're there for the National People's Congress as you continue to gauge China's reaction, of course, to these tariffs. What are you watching for in the days ahead, and to what extent the trade threat from the US is going to be casting a shadow over what transpires in Beijing in the days ahead?
Yeah, I don't expect the leaders that gather here for the NPC, which begins tomorrow, and also the CPPCC, which is the advisory body, the much larger advisory body to the NPC, which are gathering this afternoon. That's why everyone is here. They're about to go up to the into the Great Hall of the People behind me. I don't expect them to necessarily come out and talk directly about the U.S. Threat and the U.S. Tariffs, other than to say that their external environment has become much more challenging. MOFCOM took the lead as far as the direct accusations and the moves of retaliatory and countermeasures taken. But obviously, this is an economy here that is struggling to gain footing at a time when the real main pillar of growth has come from exports. Those are going to be under threat if a key export destination like the United States is now going to be levying 20% tariffs, with a threat that possibly could go up to 60, as Donald Trump promised on the campaign trail. So exports are going to be a little bit weak. They need to drive domestic consumption. There needs to be end markets, viable markets for the products that have been, described as industrial overcapacity here. Where do they go? Well, they need to go into the local market. You're going to see a lot of policies trying to stimulate domestic demand. That means raising the budget deficit target, much higher than 3%, which it is now, to possibly 3.8%, upwards of 4% possibly. That would be the highest in 3 decades. So they're going to stimulate. The markets have been waiting, Tom. You know that. Every meeting that we've had over the last several months, whether it was the third plenum, whether it was the Central Economic Work Conference, the markets didn't get the kind of fiscal stimulus. Show me the money. They didn't get it. We're going to probably get it tomorrow in Premier Li Qiang's work report at 9 a.m. here in the building behind me, the Great Hall of the People.
OK, great reporting from our chief North Asia correspondent, Stephen Engel. On the ground for us in Beijing, the reaction, of course, from China retaliating against those US tariffs and what to watch for from the National People's Congress and potentially additional stimulus. Steve, thank you. When you talk about China, the Chinese economy, of course, you think about the oil markets. The oil markets today under pressure for different reasons, arguably. OPEC Plus coming through and suggesting they're going to be putting and announcing they will be putting more oil on the markets. That brings us to earnings coming through from Saudi Aramco, a key part of that metric, of course, when it comes to OPEC Plus. And the top line coming through in terms of full-year operating profit for Saudi Aramco, currently coming through full-year operating profit. This is a redhead, 774 billion rials. That is just slightly below the estimates. It is announcing and has announced that it will and expects to pay a total dividend of 85 billion US dollars in 2025. Of course, a big chunk of that will be going to Saudi Arabia and the state government, of course, itself. So those lines crossing from Saudi Aramco is a story we'll bring you more details on in the hours ahead. We're also getting details and lines crossing on the earnings story from a major defence contractor, Thales, of course. And this is one of the companies that has performed incredibly strongly year to date. The stock is up about 60% year to date. Thales 2025 sales forecast beating estimates, full year earnings coming in at 2.42 billion. That was above the estimates of 2.3 billion euros. Fourth quarter sales also beating for Thales, and they see 2025 sales of between 21.7 billion euros to 21.9 billion euros. And at the top end of the range, that is a beat on the estimates. So some relatively strong numbers coming through from a defence contractor that has seen a very strong run-up year to date, along with its counterparts, of course, on expectations there'll be more spending coming through from Europe to support the defence space. Coming up, Donald Trump halting deliveries, talking of defence, halting deliveries of military aid to Ukraine following the Oval Office fallout with Volodymyr Zelensky. We look at the impact of that decision on the war next. This is Bloomberg. Donald Trump has paused all US military aid to Ukraine just days after his Oval Office bust up with President Zelenskiy. A Defense Department official has told Bloomberg it won't be resumed until the US president determines that Ukraine's leaders are demonstrating a good faith commitment to peace. Let's get more details then from Bloomberg's Oliver Crook. What does it actually mean for Ukraine and its military operating on the ground then, Ollie?
Yeah, so listen, from what we understand, this is basically not only there was already a freeze to some of the financing, part of the USAID cutoff. This is already sort of priced into what was going on in Ukraine. Now we understand that there's actual preventing physically of the delivery of hardware, incoming hardware that could be coming, as well as stuff that is already in the air, stuff that is waiting on the border with Poland. All of that stuff is going to be frozen, and there's still about $4 billion worth of aid that Trump has inherited, the sort of clearance to give to Ukraine from the Biden administration, and that appears to also sort of be on pause. So this is just turning the screws, really the consequence of what we saw from that press conference that went obviously catastrophically on Friday between Zelensky and Donald Trump. The question is going to be, I mean, this is all sort of from our reporting. We haven't heard from Trump sort of officially on this. We're expecting to hear from him a little bit later today, about 1 a.m. UK time, when he's going to go speak on this. But again, this is going to this sort of minerals deal that is still apparently on the table to a certain degree. It's very hard to know. Zelensky said he would kind of sign something. Trump says he still kind of likes the deal. But again, it doesn't resolve the sort of grand ambiguity that rests over all of this, which is for the Ukrainians, how do you get lasting actual end to the war? And Trump, who just basically does not seem willing to give the security guarantees that the Ukrainians and the Europeans would like. And at the end of the day, you need to come to a common reality on what is going on in Ukraine, whether who is the aggressor, who is the victim, and that does not seem to be very sort of clear from the Trump side of the thing, and it's going to be very hard to make a lasting peace under those conditions.
There's one reality based on fact, which was Russia was the aggressor and invaded Ukraine, and one which is not based on fact. And this is another decision by the Trump administration, objectively, that will be cheered in Moscow by
Which
Russia.
has been cheered.
And has been cheered.
Yeah.
Talk to us about whether or not Europe can fill the gap when it comes to this military hardware.
The reality is no, it cannot in the long term. It can for maybe a short period of time. It can continue to provide some of the things that the Europeans have. But again, this has been the very beginning. The Europeans have given a lot more in terms of monetary volume. They just don't have the kit. So they're trying to build up their defense industry, as we've been reporting on for the last couple of years. But we talk about building a new plant for these sorts of, tanks or any of this hardware. These are years in the making. We know that there's a lot of partnerships going on already within the borders of Ukraine with some of these defense companies, but they just do not have the volumes. They do not have the ability to basically match what the United States has been filling. And further to that, if the United States wants to further turn the screws, it's not about just delivering hardware, it's about the operational on the ground. It's also withdrawing surveillance cover. It's withdrawing kind of information. It's withdrawing the kind of maybe updates and the operating of some of this kit that you need to have the American know-how to basically operate in the field. So these are all parts of the potential equation. And further they want to turn the screws, they are absolutely able to do that.
Okay, Oliver Crook, thank you very much indeed. The story continues to evolve, of course, and we bring you all the details when we get them, and the impact, of course, on the fighting forces of Ukraine on the ground as they continue, of course, to engage in that conflict and defend their nation. Coming up, Aramco has cut the world's biggest dividend, a blow to Saudi Arabia's finances. We're going to go to Dubai for the details on that story. That's next. This is Bloomberg. Saudi Aramco has cut the world's biggest dividend in a blow for Saudi Arabia's widening budget deficit. This as the oil giant seeks to ease pressure on its own finances. Let's bring in Bloomberg's Jumana Pasechi in Dubai. He's been across all these numbers for us. Jumana, this, of course, following the decision by OPEC Plus to put more oil on the market. Talk to us about the earnings and the interlink between these two stories.
Yeah, well, clearly there's a strong interlink here because what we did get out of these numbers was that the operating profit slipped 11% year on year, revenue down 1% year on year. But even in the commentary that they put out, they said that that points back down to the fact that oil prices are lower. And of course, Saudi Arabia are producing less than their full capacity, just sub 9 million barrels a day. But I think the key takeaway from the Aramco earnings that everyone has been watching out for is the guidance on the dividend payments. And they have announced that they expect the total payout for this year to be about $85 billion. Compare that to $124 billion last year. So they are reducing the total payout for the dividend. And why do I say total payout? Because the dividend itself is comprised of a base dividend payment in addition to what they call a performance-linked dividend. And that performance-linked dividend is linked to extra free cash flow. You will remember that they had a massive influx of revenues after the 2022 energy crisis when oil prices spiked up. And on the back of that, they decided to start paying out more with this performance-linked dividend. Now that oil prices are coming under pressure, they've guided to a lower dividend payout overall for the year, which may have knock-on effects on the Saudi government, given that they, of course, constitute the largest shareholder of Aramco. So, again, a very important indicator here. But to tie it back into the broader picture, this comes on the heels of the OPEC Plus announcement yesterday that they're going to actually start putting more barrels back to the market, as they planned, by the way, from April the 1st, of around 160,000 barrels per day. And this actually came as a surprise to the market. Many analysts had thought that they would once again postpone the decision. They've already postponed it 3 times. But this time around, OPEC Plus are saying that they plan to go ahead with those increased planned outputs, gradually restoring 2.2 million barrels per day back to the market. Now, the reaction on oil prices has been pretty negative this morning. And again, it comes back to the state of demand. To tie it back to what Aramco CEO just said, Amin Nasser, he's saying that they expect to see record oil demand this year. So an interplay of all of these dynamics.
Yeah, and contrasting with the IEA, of course. Jumana Pasechi with an important update on these oil markets and, of course, the Saudi Aramco earnings. Thank you. Coming up, we get back to the tariff story and the retaliation. This is Bloomberg. morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The global trade war escalates. The US introduces tariffs on Canada and Mexico and doubles them on China, hitting the country's three biggest trade partners. Canada and China immediately retaliate with their own levies. Donald Trump pauses all military aid to Ukraine, turning up the heat on Volodymyr Zelenskiy after that testy Oval Office meeting. Plus, sliding further, Brent crude trades near a 3-month low after OPEC Plus announces a surprise increase in oil output. Trade firmly in focus for these markets then as we adjust to the reality of an escalating trade war. Goods worth about $1.5 trillion impacted by 25% tariffs on Canada and Mexico, an additional 20% tariffs on goods from China. The retaliation coming through from Beijing, the retaliation coming through from Ottawa. European futures pointing lower by 0.8% after notching a fresh record high yesterday on the defence trade. FTSE 100 futures pointing to losses of 44 points, down 0.5%. S&P futures, though, turning more positive after a rout yesterday of around 1.7%. A significant drop in the S&P yesterday. The Russell 2000 small caps were crushed. The Nasdaq 100 as well. Tech heavy, and the tech names took a beating yesterday, particularly the likes of Nvidia. Currently today, though, Nasdaq 100 futures pointing to gains of 97 points. We'll see if that holds as we build up to the open in the US. Let's flip the board and look cross-asset. Markets now pricing in close to 3 cuts from the Federal Reserve. The data out of the US is looking fragile. Is US exceptionalism now coming to an end? And what will the impact of tariffs be in terms of growth and inflation? 4.15 on the benchmark 10-year. Euro-dollar at 104. Brent under pressure on OPEC Plus' decision to put more oil onto this market, down 0.7%, and Bitcoin falling again in the session, down 1.4% at 84,000. So China says it will file a lawsuit at the WTO against additional US tariffs. President Trump doubling levies then on Chinese goods to 20% and went ahead with 25% levies on goods from Canada and Mexico. Canada retaliating with tariffs which will eventually hit $107 billion of US products.
We know that this is an existential threat to us, and there are thousands of jobs in Canada at stake. Now, we've done the work. We are ready should the U.S. decide to launch their trade war. We will be ready. We are not looking for this. We're not seeking this.
OK, Canada's foreign minister speaking there, and Canada has indeed retaliated. Let's bring in Bloomberg's Katia Dimitrieva now for the latest. Katia, a lot of tariffs being announced, a lot of retaliation. What is the latest when it comes to Beijing's response?
Well, Beijing's response was very prompt indeed. We got news very shortly after we passed the sort of deadline for when those U.S. tariffs came in, and we know a number of moves they've taken. Up to 15% tariffs on agricultural goods. So that includes beef, chicken, some fruits. Additionally, there's going to be 10 U.S. entities placed on a special blacklist. China has this blacklist of entities. They've placed an additional 10 companies onto there as well. Illumina, a major U.S.-based company in this scope of DNA genome sequencing, has also been banned from selling its products in China. And so there's sort of a range of responses here, but you'll note that, in fact, China's response is not at the same level as the U.S. So when you compare sort of 25% tariffs on Chinese goods to up to 15%, as well as the scope of items, so we know that all Chinese goods coming into the U.S. will be tariffed, but it's not the other way around. And so you'll see a bit of that, which is exactly what happened. The first round of 10% tariffs, we saw a more muted response from China.
Yeah, eventually China runs out of goods, doesn't it, to actually put tariffs on. What about Canada and Mexico in terms of their response so far, Katia?
So we already knew Canada was going to respond. Trudeau had said that unless these tariffs are pulled back, that they're going to impose these kind of 2 tranches. The bigger ones come later in about 3 weeks' time. Right now, about $20 billion in goods are being targeted. That's targeting about $20 billion in U.S. goods coming into Canada. And Mexico, we're expecting a press conference with the president at 7 a.m. local time. So we'll probably get a bit more details then about what their strategy is. But Mexico has also said that it's looking to protect its industries and will definitely come up with some proposals. We just don't know specifics yet.
OK, Bloomberg's Katia Dimitrieva, thank you very much indeed on this escalating trade war and the response from Canada, Mexico and China to these Trump tariffs. Thank you. Let's get more analysis now and bring in Hetal Mehta, Head of Economics Research at St. James's Place. Hetal, good morning. Thank you for joining us. What does this trade war mean for the global economy? What kind of impact are you modelling in terms of the growth impact going forward through this year?
So I think it's, now that we've also seen the retaliation, it's clear it's lose-lose. Even before the tariffs have kicked in, we saw that kind of trade policy uncertainty skyrocket. So a series which hadn't previously breached 100 until Donald Trump became president in his first term is now kind of around 300. So a huge increase in that uncertainty, already starting to bear down on sentiment and confidence. In terms of the kind of near-term impact, these tariffs would take the effective tariff rate, just taking the Canadian and Mexican tariffs, should take the effective tariff rate up to above 10%. And then you add the Chinese tariffs on top. So we're looking at a hit to inflation, as in an increase, and that's inevitably going to curb the purchasing power of consumers. So you get that effect just on the US, and then there's the spillovers. The retaliation will also mean, it's a kind of drag on growth globally. So we're looking at a slowdown. Now, I thought that the impact of the tariffs would take a while to build, but as I said, we're starting to see some evidence of the slowdown already. And so this is going to be a kind of a long process, I think. But much. There's still a lot of uncertainty, though.
Yeah, there's a lot. There's a lot to unpack there, isn't there, in terms of the potential impact on inflation and growth. I want to just play some sound from the Fed's Musalem, one, of course, of the officials on the FOMC, talking about that inflation story in the US and the consumer. Let's listen to that, and I'll get your reaction.
A deterioration of the labor market alongside higher inflation could present difficult choices. With inflation already above 2% and a full employment labor market, the stakes are potentially higher than they would be if inflation were at or below target, and if consumers and businesses had not recently experienced high inflation, perhaps raising their sensitivity to it.
OK, Alberto Musalem, then, of the Fed, speaking there. Hetal, what is your expectation? Markets now pricing in potentially close to 3 additional 25 basis point cuts from this Federal Reserve. Does the Fed put the emphasis on the growth impact or the inflation impact? This is a challenging set of decisions going forward for this Fed.
It is. Stagflation is probably the kind of nightmare scenario for any central bank. So we've got this slowdown in growth, but the inflation numbers, I think, will still take precedence. So I don't think we will see cuts from the Fed coming through very quickly, unless there is a further kind of leg down in growth, because for them, this, as we just heard, there's this kind of almost inflation memory, because inflation has been high. It doesn't take much to take inflation expectations up further. Wage growth is still relatively robust, and so there is that concern of those second round effects, and I think that's why we might. I don't think we'll get hikes. I think the bar is very high for that, but I think keeping that kind of the talk quite tough is going to be key in the near term.
Does it kill the US exceptionalism theme?
I'm not sure how much we really bought into the theme anyway. I think it's obvious that the US will have some advantage, the kind of reserve currency status. It can run these big deficits for a long time, but I don't think that what we're seeing certainly now is kind of a dramatic change for our view. The exceptionalism for me is really down to now, can the fiscal side in any way cushion the impact of tariffs? And I think the answer there is probably no. The US is already running a big deficit, and actually the tariffs also, as the effective rate goes up, it's not clear it will generate that much extra tariff revenue, and the hope was to recycle that in terms of tax cuts. If that doesn't come through, it's a kind of Laffer curve, if you like, when it comes to tariffs. Yeah. That I think that's going to kind of keep that slowdown in train.
Well, Hetal, when it comes to Europe then, I mean, this has to be a warning for European leaders that tariffs are very likely to be coming down the pipeline. I mean, we know just to what extent there's animosity when it comes to Trump and his views on Europe. So we have to brace for tariffs in Europe. Can the fiscal spend on defence and can the ECB cuts provide a cushion for the European economy?
So I think in the near term, the cuts from the ECB can help a little bit. But the defence spending, I think, will take time. These things do take time, not only to agree, but to actually take effect. The supply chains can actually be quite long in terms of defence spending. So I do think that will help, but eventually. And the other thing about defence spending, where a lot of the money is coming from alternative vehicles, so the idea of, say in the UK, money that was going to go towards infrastructure may now go towards defence. This is economically less productive in terms of boosting that kind of output potential. So in the years to come, it might be hard to quantify in the near term, but in the years to come, when we talk about this productivity puzzle, we may be spending money on something that is necessary, but will probably come at the expense of that kind of capacity, that infrastructure investment. So I think it will help, but the second round effects of those growth, that stimulus, I think will be more muted.
OK, so look at those second round effects of that stimulus. Hetal Mehta, Head of Economics Research at St James's Place, in terms of how the economy globally will adjust to this trade war. Thank you. Some details breaking right now when it comes to Hensoldt and a number of other defence stocks as well, called higher in trade market before the open, of course, at Tradegate, I should say, as we lead up to the UK Open at 8 a.m, the European Open at 8 a.m. You're seeing Hensoldt gaining 15% on Tradegate versus the extra close of yesterday. BAE Systems also called higher by 8.6%. This is another story and a reminder that defence stocks continue. That trade continues to have legs, it seems, after the strong performance of defence and that sector yesterday. You're looking at further upside. This, of course, on the news that the US administration is halting military aid to Ukraine, and undoubtedly an expectation that these European defence names will have even greater demand. So we watch the defence stocks again today. Coming up, our exclusive interview with a global leader in generative AI. We're going to discuss the challenges facing startups trying to scale the technology and what trends to watch in 2025. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the AI startup Anthropic has just completed its latest funding mega round, raising $3.5 billion. That values the OpenAI rival at $61.5 billion, cementing its place as one of the largest startups in the world. Staying on the AI space with a focus on data analytics, I'm very pleased to say we can now bring in someone who's focused on the challenges of embedding AI and making use of enterprise data. Naveen Rao, Vice President of AI at the data and AI company Databricks, also very fast growing, recently announcing a $15 billion round in financing and also valued a little over $60 billion US. Naveen, thank you for your time. You're in Barcelona for the Mobile World Congress. Talk to us about what Databricks does, the proposition, how much enterprise appetite there is in Europe for the kind of solutions that you are offering at this time.
Yeah, Databricks provides an entire modern foundation for your data. I think we're seeing a shift going from siloed data from different SaaS sources and different SaaS applications into one unified foundation, kind of a single source of truth across all applications. That allows you to contextualize and customize AI for the enterprise, which is really where we believe the value is.
What is the expected kind of do you have a kind of framework in terms of the expected enterprise value? I don't know, across sectors or regions. Or what kind of value could be unlocked as a result of some of these applications?
Yeah, we believe that most of the enterprise value is going to come from leveraging one's own data. That becomes the moat, the advantage that a company has in their competitive arena. So I think, having access to general capabilities like general models from Anthropic, OpenAI, other providers is great, and it kind of moves everybody up. But really, the competitive differentiation is going to come from using your data specifically for an advantage. And we call this concept data intelligence, as opposed to general intelligence, where we can actually derive specific sorts of intelligence from your data.
Can you give us some use cases in terms of examples of use cases that are providing real return on investment for enterprise customers?
Yeah, I mean, understanding how your customers are viewing a new product, or even in real time during a support call, whether a customer actually wants a different product or wants to be upsold or downsold, or basically operational efficiencies around understanding your business better. That's on the operational side. We're seeing soon transformations like understanding your code bases and making the actual engineering process of developing new products quicker, faster, being able to iterate quicker, improving quality at a faster rate. These are all the kinds of things that we see here, just really kind of a sort of a jetpack strapped onto the development process of any engineering endeavor.
Naveen, look, there's a number of equity analysts out there who are kind of pointing their lens at the earnings story when it comes to enterprise, when it comes to corporates, and suggesting we're not seeing a real impact on ROI. What is the kind of time frame? When do we start to see this having a positive impact on the earnings story?
Yeah, I mean, just like any major transition, like the Industrial Revolution, it takes many years. This will be measured in decades. It's not going to happen overnight. And the reason is there's lots of systems that have to adopt these new capabilities. So, we first saw that security governance were actually quite important to rolling out an enterprise application. You can't build a new app unless you understand how you can secure it, how you can prevent leakage of information, that kind of a thing. We're just now getting to that point. Databricks is actually providing those tools. The next side of it is actually user interface, building the correct user interfaces to consume intelligence when you need it, where you need it, to the user that needs it, is actually quite important. And this hasn't really been cracked. I mean, a chatbot was kind of the first version of this, but it's a general interface that's not something that will apply to all applications. Like, coding interfaces have actually taken off because they supply the right insight at the right time. So I think this is where we're going to see a lot of innovation over the next couple of years, and actually the subject of my keynote coming up in just a few minutes.
What are the main headwinds when it comes to adoption? Is it regulatory? Is it, particularly when it comes to Europe, is it risk aversion? What are the headwinds to adoption?
Actually, we don't see that yet. There are regulatory hurdles, and we conform to all of those local rules. So whether it be in the U.S. or Asia or Europe, we try to conform to all of these local rules when we sell into these markets. So we don't see regulatory as being a huge impediment just yet. I think people, conforming to the GDPR rules to customizing these models and making sure they're safe is actually quite important. So what we really see is that do they have reassurances that there won't be hallucinations? Is the performance at a bar that adds value? Is my data secure and safe? These are actually outside of regulation and much more about just the technology stack isn't quite there yet, and it's emerging right now.
And Naveen, I want to ask you about geopolitics and the interplay between geopolitics and technology, because we're getting a reminder today, and there are some in Europe now, really questioning whether or not the transatlantic alliance is fracturing. I just wonder if you get a sense from some of your clients in Europe as to any caution in terms of partnering with US tech companies, given the pivot that we've seen from the Trump administration.
I mean, like I said, we conform to all the rules in the local geo where we sell. We're seeing a lot of demand for this modern data architecture in Europe. It's actually one of the big growth areas for us. I think there's a lot of industries that are transforming their way of doing business and the way of operating. So, we don't see anything like this. It's early days. It's hard to predict these things, of course. But so far, companies are rational. They want to buy the best solution. And Databricks has one of the best solutions in the world for this modernization capability. So, it's not something that's hit us recently. We're very much in this hyper growth phase.
Yeah, recently partnering with SAP, of course, the German global software provider.
Right.
Databricks Vice President of AI, Naveen Rao, thank you very much indeed. If you're in Barcelona, tune in, of course, to that keynote speech coming up shortly. We appreciate your time. Now to some other stories making news. This Tuesday, TSMC, the world's top producer of AI chips, says it will invest an additional $100 billion in US plants, supporting President Trump's goal of increasing domestic manufacturing. The chief executive of Taiwan Semiconductor joined Trump at the White House, as you can see, to unveil the plan. The investment will bring TSMC's American presence to a half-dozen plants for advanced wafer fabrication and 2 more for advanced packaging. The UK's Financial Ombudsman Service says complaints from financial services customers climbed more than 40% in the final 3 months of last year. Motor finance was the biggest category, with a pile of cases stuck in legal limbo. The UK Supreme Court is hearing several cases about missold motor finance, with a decision expected later this year. Moody's has said car loan mis-selling could ultimately cost the finance industry £30 billion. There's plenty more coming up. Stay with us. This is Bloomberg.
The Fed will be more likely to look at the whole puzzle, not just one action. So I think the Fed, at least in this upcoming meeting, is most likely to do nothing. And they're going to take it one meeting at a time and try to assess these changes.
Goldman Sachs Vice Chair and former President of the Federal Reserve Bank of Dallas, Robert Kaplan, speaking there. Let's get to the FX impact then of the tariffs and the trade war that we have now entered into. Relatively muted. Yes, there's some downside coming through from the Mexican peso, currently down 0.2% versus the US dollar. The yuan, though, a little stronger by 0.2. Support coming through in terms of the fixing, and a reminder that Beijing is not in a rush to weaken that currency to offset the tariff impact. The Canadian dollar, the loonie, currently largely unchanged. The Bloomberg Dollar Index also largely unchanged. We'll see how this permeates through the session. We look ahead, of course, to President Trump's address to Congress later today. Let's flip the board and have a look on the equity story, because the Trump trade has faded, particularly when it comes to the equity story. You have made, in terms of since Trump came into power, the gains that came through for the S&P have now been erased. You've seen money moving into treasuries, of course, and yields falling. The two sectors facing the biggest pain, interestingly, technology and energy, despite the members, of course, of that Congress and that cabinet who are aligned with Trump on those issues. But the sector most impacted, energy and tech, the S&P has erased the gains since he's taken office. Let's have a quick look in terms of Fed pricing. Markets now pricing in almost 3 cuts from this Federal Reserve as they adjust to weaker data out of the US. We're going to be talking, by the way, with the CEO of Bill Finger, Thomas Schultz, at 7:30 a.m. London time. Later in the Pulse, Francine Lacqua will be joined by the CEO of Continental. This is the company says it sees limited improvement to profitability this year. That's at 9:30 a.m. London time. But before all of that, continued focus on the trade war with the opening trade. That's coming up. This is Bloomberg.